Hello, and welcome to this video tutorial on the Portfolio Snapshot Report. This report provides you with detailed information about a portfolio's holdings, as well as some performance and return information. You can choose to run the report on the client's current portfolio and the proposed portfolio. The first section on this report is the broad asset allocation pie chart. The question with this part of the report is whether the asset mix seen here is appropriate for the client's risk tolerance. Are they too heavily invested in securities or not enough? As we can see, the portfolio is well distributed in foreign, Canadian, and U.S. equity, as well as in bonds. The investment style area shows us how the portfolio's assets are distributed amongst its equity and fixed income holdings. Again, the question to ask is whether this equity asset mix is compatible with the client's risk tolerance. If the portfolio has exposure to fixed income, examine the breakdown in the fixed income style box. We can see that the portfolio is strongly concentrated in large cap, predominantly in value-oriented stocks. With hardly any exposure to fixed income, the fixed income style box is not populated. The stock sector area shows us the breakdown amongst the stocks in terms of what types of industries the portfolio is invested in. In reviewing this information, the portfolio has just under 10% of its assets in the information economy, just over 50% of its assets in the service economy, and just over 38% of its assets in the manufacturing economy. Another aspect to look for in this graph is whether the portfolio is making any significant sector bets on just one or two areas. If so, that will bring an additional measure of risk to the portfolio. The regional exposure section reflects information only on the stocks in the portfolio. Note that the graph shows us that almost 66% of the stocks in the portfolio are North and South American. The performance section shows us returns information for the portfolio for the trailing 3-month, 1-year, 3-year, 5-year, and 10-year periods. You can also see how the portfolio performed compared to its custom benchmark. You can also see the best and worst time periods for this portfolio to see what kind of swings it has produced and how it has performed in different types of markets. The investment activity graph shows you how the portfolio would have risen and fallen over the past 10 years. In this section of the report, take note if there are any peaks and valleys in the portfolio. Look at the period from mid-2002. This represents a notable loss for the portfolio. The last section on the first page of the report shows you the top 10 holdings in the portfolio and what percent of the portfolio's assets each investment contributes. Look to see if the portfolio is dominated by just one or two holdings. At the top of the second page, you can see some fundamental analysis on the underlying stocks that this portfolio owns. This portfolio invests in developing markets, which brings less risk than investing in emerging markets. Beneath the fundamental analysis section is the risk analysis section. The risk-reward scatter plot here shows you how the portfolio compares over the past 3 years against its benchmark. The benchmark is represented by the black square. The solid black circle is the portfolio. Each holding within the portfolio is represented by a hollow circle. The ideal location for the portfolio is the upper left quadrant. This would mean that the portfolio has outperformed the benchmark and took on less risk than the benchmark. In our example, the benchmark outperformed the portfolio but took on less risk than the portfolio. The performance history graph to the right indicates whether the portfolio outperformed or underperformed a benchmark on a quarterly basis going back 10 years. The risk-return statistics section shows you the standard deviation, mean, and Sharpe ratio for both the portfolio and its benchmark over the past 1, 3, 5, and 10-year periods. Finally, the Sharpe ratio indicates whether the excess return is due to intelligent stock picking or simply taking on additional risk. The higher the Sharpe ratio, the better. Next, you can see the modern portfolio theory statistics for this portfolio, the alpha, beta, and R-squared. The R-squared score is a measure of how closely an index can explain a portfolio's movement and also reflects how reliable the alpha and beta scores are. If the R-squared score is not at least 80, the alpha and beta are not reliable. The higher the R-squared score, the more meaningful the alpha and beta scores are. Beta is a measure of risk for a portfolio. A beta of 1 means that the fund moves in the same way its benchmark does. A beta less than 1 means that the fund is less risky than the overall market, while a beta of greater than 1 means a fund is more risky than the benchmark. Alpha reflects a portfolio's returns in light of its beta. Any positive alpha score means that the portfolio is earning returns that are more than compensate for the risks being taken. The last section of the Portfolio Snapshot Report shows you the returns for each holdings. You can use the 3-year returns information to help you decipher which investment is which on the risk-reward scatter plot graph. Thank you for watching this video tutorial on the Portfolio Snapshot Report.